Welcome back, everyone, to this live session at Deep Value Summit 2013. It's a great pleasure to have all of you with us. We have a great session ahead. This session will work as follows. Oliver will introduce the instructor. The floor will then be his for his remarks. Feel free to type in your questions at any time into the online interface. We'll have a Q&A session following the remarks. And with that, I'd like to turn it over to Oliver.
Thank you, John, and welcome. Really looking forward to having Toby Carlisle with us. Toby is the founder and managing member of Equim Investment Management. Toby will be familiar to many of you as the author of the wonderful blog Greenblatt, as well as the co-author of the book Quantitative Value, which is a must-read for value investors looking for a more systematic approach to security selection, which is less prone to some of the behavioral errors that investors often make. Toby brings to investing also an additional skill set as a lawyer with particular experience in M&A law, and has in his early career been involved in transactions across a variety of industries in the US, the UK, and throughout much of Asia. Today, Toby will present his best deep value investment idea, which is a NASDAQ-listed equity, as you can see here on the slide, with a market cap of about $850 million. And with that, I want to turn it over to Toby for his remarks. Please go ahead.
Thank you, Oliver, and thanks, John, also for the opportunity to speak today. I very much appreciate it. The topic today is Kulicke & Soffa, which is listed on the NASDAQ KLIC. Before we get to the stock, though, I want to describe to you a little bit about the process that I undertake, which I think is a little bit unusual. So let's get started. If any of you have seen the movie Moneyball or read the book, I think that it's the best movie or book ever written about quantitative value investing. And the reason why is that it sets up this story where, on one hand, the old guard, represented by scouts who use their gut feeling to make these subjective assessments of players. Does he have a good face? How does the ball sound when it comes off the club? And that's contrasted with Billy Beane's new econometrician, Paul DePodesta, who used a variation of sabermetrics, which was a much more statistical method of assessing how good or bad a player was. And so over the course of the movie we see, or the course of the book, we see how they attempt to buy undervalued runs by using these unusual metrics, and that leads them at the end of the movie to have this unprecedented run of wins. And Billy Beane makes the comment that he's trying to be a card counter, that we're sitting at the table counting cards. So that concept fits into a much broader array of research, and the most famous of which is the Minnesota multiphasic personality inventory test, where Dr. Goldberg sat down with the admission forms of patients who had presented at a hospital, and he found the various indicators of whether somebody was psychotic or depressed. And the difference is only a little bit on presentation, but subsequent diagnoses could determine with some greater degree of accuracy. And so he found that the worst psychologists got the diagnosis right about 55% of the time. The average psychologist was about 62%. The very best psychologist got it right about 67% of the time. But Goldberg found that if he applied his simple model after assessing the 1,000 presentations and their subsequent diagnosis, the simple model was able to get it correct about 70% of the time, which outperformed all of the others and even the best. So this is where the study gets interesting. Goldberg took his simple model and he gave it to essentially students and experienced diagnosticians, and he ran the test again. And this time he said he tracked how the experienced physicians did, and as you can imagine, they didn't perform as well as the experienced physicians. When they were given the benefit of the model, though, both of them improved their decision-making ability. And you can see that the inexperienced psychologists actually outperformed the most experienced psychologists when they had the benefit of the model. Experience, again, led to outperformance with the model over everything else, but the simple model continued to outperform all of them. So, to show to you that this isn't a cherry-picked study and that these are representative of the area of research, there have been 136 studies and meta-studies, which are studies of studies. They found that 64 of them, which is about half, favoured the model. 64 showed the same result, and only 8 favoured the experts. And so that leads us to a practical conclusion, and that practical conclusion is that simple models outperform experts. And this is the shocking part. Simple models outperform experts even when the experts have access to the simple model. And the reason why that occurs is that humans and investors make a series of behavioral errors. The first one is overconfidence. And the way that that manifests is we prefer our own opinion to other opinions. And so if we're presented with, we're asked a question about something that might occur in the future, we'll make a decision based on what we know. And then if we're provided with statistical evidence or an expert's opinion, what we should do is equally weight both or favour the expert, but what we tend to do is overweight our own subjective opinion. Another one that is particularly harmful to investors is neglect of the base case. So we'll see in a moment what that means for value investors. But what that means is that given a statistical expectation about a future event, we focus on the wrong information and neglect we focus on information in relation to the case that we have in front of us and not in relation to the statistical expected event given all of the information that we have. The next two are interrelated and best illustrated by several studies. The narrative fallacy is when we're presented with information, we want to describe the information in a coherent way, and the way that we do that is we create a story about how that information came to be. And the problem with it is, as we're presented with new information, we try to fit it into the story that we've already created rather than modifying our understanding of what's occurred. So that there are two studies that stand out that demonstrate how this occurs. The first one was horse racing and discussions with handicappers of horse races. So the researchers examined lots of different statistical information about the expectation of any given horse's chance of winning a race. Then they found experienced handicappers and they provided them with 20 data points of information. But the wrinkle was they provided those data points in a randomized fashion. So any given handicapper might have received any given piece of information first, and then they could receive a different piece of information second. So what they found was that the handicappers made their decision based on the first piece of information or the second piece of information that they received, and then they examined each subsequent piece of information as the degree to which it fit into the story that they had already told themselves about the horse. And as each data point was provided to them, they were asked about the confidence of their prediction. So what they found was that as each data point was provided, the confidence went up. They became increasingly confident about the accuracy of their decision. But the accuracy didn't in fact improve. The accuracy stayed the same throughout the entire exercise. And a similar study occurred in 2008 using college football. They were first provided with a list of a questionnaire to determine which college students were experts on college football. Then they took those students, provided them with the randomized information, and once again they found that their confidence in predicting the outcome of the football games increased with each piece of information, but the accuracy stayed the same because they were basically making the decision on the first piece of information that they found. And that's the reason that we do that, is that we have this preference for complexity. And the most famous study for that, demonstrating that preference, was 1977. Two subjects would be seated beside each other, and on a screen would be a cell, and they had to determine whether the cell was sick or healthy. And the wrinkle in this exercise was that only one subject was given the correct feedback. The other subject was given feedback based on the feedback provided to the first subject. So as more and more of these cells were put up, the first subject actually began to learn how to distinguish between sick and healthy cells. And they came up with these simple rules, and their ability to predict improved. The second subject, who was given feedback based on what the first subject, he was given the first subject's feedback, his ability to detect whether the cell was sick or healthy didn't improve at all. But he came up with these incredibly ornate, adorned ways of assessing the sickness or the health because he wasn't getting the right feedback. And this is the most interesting part of the study, is that midway through the study, the two subjects are allowed to meet and allowed to discuss their rules. So the first subject, who we know has been improving and has simple rules, listens to the second subject, who thinks that he's been improving, but he's actually been seeing the second subject's assessments. And his rules are incredibly complex. And the first subject is so impressed by the complexity of the second subject's rules that he begins to adopt the more complex rules, and they don't perform as well. So to put this into a value investing context, I think we first have to ask, does value investing work? And I know that there are statements by Buffett to the effect that simple price ratios, low price to any fundamental, doesn't necessarily equate to value investment. But for the purposes of this study, we can define it as a low price to a fundamental. And what this slide shows, we backtested from 63 to 2011, forming a portfolio once annually using lag data and in a big cap universe. And so this shows the excess return over the market or the deficiency under the market. And you can see that the value quintile across a variety of value measures outperforms the market substantially. And I think if you focus on the little blue bar, the EV/EBITDA bar, you can see that that universe, that's a quintile, so that's about 400 stocks, outperformed the market by 4.5% on average over the course of that period of time. So the implication of that is that if you're an investor and you had simply focused on that price ratio and done nothing else, you'd have been able to invest a great deal of money because they were large caps and there were several hundred of them. And you'd have outperformed the market by an amount that would have made you a famous value investor. And all you would have been doing is using a single price metric. Benjamin Graham was able to figure this out earlier than anybody else. He had written security analysis in 1934 and had quite complex rules in security analysis. But in 1976, towards the end of his life, he made this statement in an interview that he no longer used those elaborate techniques. He preferred a much simpler technique, and his simpler technique was it has to have a price to earnings ratio below 7, and it has to have a debt to equity ratio below 50%. And he had said at that stage that he had back tested it and found returns in the order of 15% for the period 1925 to 1976. That's about a 50-year period. We've also backtested that, and we've found approximately similar returns, a little bit over 15%. There are problems with that strategy, and that's that the securities are so few and infrequently available that you have to be heavily concentrated into a handful or one at any given time. So there are better strategies out there, but it's still a very good strategy. Everybody will be familiar, I think, with the magic formula, which is Joel Greenblatt's The Little Book That Beats the Market. So Greenblatt decided that he wanted to test a mechanical version of Warren Buffett's strategy. It's far better to buy a wonderful company at a fair price. And so simplifying that into, it has to be a high quality company and it has to be available at a low price. And Greenblatt then was able to backtest that. These are our backtest results, and our backtest results are slightly lower than Greenblatt's, but that's because we analyze the stocks by making it a larger market cap universe and by market capitalization weighting. But it doesn't matter. It still outperforms by a substantial margin, and that's genuine outperformance that would have been available for that period. Greenblatt, to his great credit, went on to examine investors using his magic formula and looking at the results. And so he had this website where users could sign up and they could either take an automatic account where it was the rebalancing occurred according to the rules in the book and it was complete.
Well, it seems we're having an issue hearing and seeing Toby.
Unsophisticated investors.
Although there we go.
I'm sorry, guys. Did I cut out there?
Not at all. I think there was just a connection issue, but go ahead, please.
What have you missed?
I think just about 15, 20 seconds. So if you, yeah, we were.
Did you see this chart?
I think that's where we were.
Okay. So this chart shows that the automatic accounts massively outperform the S&P 500, and the self-managed accounts not only underperformed the automatic accounts, but they underperformed the S&P 500. So users took what was a winning strategy and they used it to underperform the market. And the reasons why: they don't follow the rules closely enough. They get discouraged if they underperform for a brief period of time. And Greenblatt's done a lot of work where he's said you can expect this strategy to underperform 1 year in 4, and I think 4 months in 7 or something like that. As the periods go out longer and longer on a rolling 5-year basis, on a rolling 10-year basis, the expected outperformance frequency approaches 90%. And to demonstrate that this is not just a matter of unsophisticated investors failing to apply the magic formula, again, to his great credit, Greenblatt has come out and said, we tried to outperform that strategy, that quantitative screen, and we weren't able to do it. And if anybody should be able to do it, it's Joel Greenblatt, who came up with it and is an amazing value investor in his own right. So in the book, we have conducted this test where we say, what are the drivers of performance of the magic formula? And we know that there are 2 elements to it. There's the value metric, which is the EBIT on enterprise value, and the quality metric, which is return on invested capital. So we can see that if we just focused on the EBIT on enterprise value metric, we'd get better performance. because the ROIC drags down the performance of the magic formula. And you can see that that ROIC might be a little bit difficult to see there, but it actually underperforms the S&P 500. I'll show you the statistics here. ROIC does about 10.37% CAGR over the entire period, which slightly underperforms the S&P 500. All of the return of the magic formula is generated by the value metric. And you can see that I know that a lot of value investors don't like the Sharpe ratios or Sortino ratios, but you can see that even adjusted for volatility, EBIT is still the better metric. So you're not giving up quality and receiving a more volatile return. You're getting a much better return. And so for me, that's deep value, where the focus is on valuation over quality metrics, which is not to say that we don't use quality metrics at all. It's just to say that we focus on deep value. So the way that that manifests is Greenblatt equally weights return on invested capital with the value metric. And he does that by ranking on each and then summing the rankings. And the way that we do it is we focus on the value decile, which is the cheapest 10% of stocks according to that metric. And then we investigate further in that decile to find the better quality and the lower quality. And we find that we get better performance from, we can outperform the value decile by doing that, that the high quality does in fact outperform. So that's essentially the Equum strategy. The name Equum comes from Michel de Montaigne. He was Michel Equum de Montaigne. He was a 15th, 16th century French philosopher, and he's regarded as the modern skeptic, the first modern skeptic. So Equum applies this strategy globally. We've done a lot of work to generate better inputs, and then we combine them together into a better structure, and that should lead to better performance over a period of time. So let me now move on to Kulicke & Soffa, which is a deep value technology stock. It's based in Singapore, and it's been listed since 1951. Sorry, it was founded in 1951, and it's been publicly listed since 1961. It manufactures semiconductor assembly equipment. I won't bore you too much with the detail of that, other than to say that many of their customers' products are put into smartphones, tablets, laptops, any product that requires a semiconductor. As of, excuse me, that should be as of yesterday, the share price was $11.54. It has 75 million shares out, not too much dilution. Market capitalization yesterday was about 870 million. From my perspective as a deep value investor, this is the sort of thing that I want to see. It's got $500 million in cash. It's got no debt. And so its enterprise value vastly understates its market capitalization. In the trailing 12 months, revenues have been in the order of 745 million. It's generated gross profit of 346 million. So gross profit is just revenues minus cost of goods sold. As we move down the profit and loss, EBITDA in the order of 180 million and $145 million of earnings fell to the bottom line, which slightly understates the free cash flow, trailing 12 months in the order of 200 million. So next I'm going to describe the process that I actually go through, or that my model goes through to find these stocks. The very first thing that we do is we eliminate from the investable universe those stocks that can have no intrinsic value. And the things that we define as not having an intrinsic value are stocks that might be frauds, might be earnings manipulators, or might be in financial distress. So we use a variety of models. These are models that you might be familiar with. So what we're looking for here is not how high the score is on any of these models. We're just looking to make sure that it's not so low that they can't be included in the universe. So you can see that that's quite a high Altman Z-score. There's no financial distress, but you could have assessed that by looking at the $500 million in cash and the earnings. The Benish score, it's not a manipulator. That's a vast distance from manipulation. Petrosky, a little bit lower at 6 out of 9, but still okay, well into the okay territory. The next step with the universe, and sorry, the effect of undertaking that task is, if you can imagine in any given year, the central tendency of, you can look at a distribution of returns, the central tendency is the returns to the value decile. If we eliminate from that value decile those with no margin of safety because they may not have any intrinsic value at all, it truncates the poor returns and it shifts the entire distribution to the right, which is what we want. So our next investigation looks at the undervalued stocks in the universe, and these are some ratios just to show you that on a number of measures it's undervalued. Price to book may be slightly higher than a deep value, but the book is all tangible, so, or a great deal of the book is tangible, and we'll come to that in a moment. 6 times price to earnings, price to free cash flow 4.3 times. And these are the metrics that we actually use, EV/EBIT, or variations of these, EV/EBITDA. On either of these, it's a very cheap stock at 2.2 times EV/EBIT, 2 times EBITDA. The reason that you get Click cheaply is because it has volatile revenues, and it doesn't always earn a profit, and sometimes it has negative EBITDA. It's a cyclical stock, and I think you can see from that chart that there's a reasonable argument to be made that it's had its peak for this cycle in 2011, and it's now falling, and that's true. I think that's the case. Over the period, it's grown. It seems silly to say that it's grown given how cyclical it is. It's grown at about 1.2%, but the 5-year average of revenue is $586 million. It's almost $100 million in EBITDA and net income of $80 million. Now, this is a quality metric that we actually use. It's called gross profits on total assets. It comes from a study by a gentleman by the name of Robert Novi-Marx, and he finds that unlike other quality measures like return on invested capital or return on assets, return on equity, gross profits on total assets actually generates performance that beats book value as a metric. So if we divide our value decile into 2 halves, according to, we rank on quality, rank on gross profits on total assets, the high quality half consistently outperforms the low quality half. So you can imagine this in the sense that this is the gross profits is the raw cash flow, or the raw accounting cash flow coming into the business. Total assets, in this instance, may be understated because Click holds so much cash as a proportion of its assets. Even so, even with that handicap, it's still in the 98th percentile of quality. So ordinarily, my investigation would finish there. I try to buy a basket of these type of positions. I'm going to go through the exercise of a more traditional analysis here to demonstrate why the utility of my strategy gives you approximately the same answer as this sort of valuation, but I can achieve it without messing around with DCFs. So I always start with a downside assessment. Here I think it's net current asset value, which is in the order of $570 million, against a market capitalization yesterday of $870 million. That's a downside of about 35%, and that's attributing no value to the business. The upside, it's a little bit more difficult to assess on a DCF basis with very conservative assumptions. So if we take the TTM earnings and we say we're going into a cyclical period, we're going to assume no growth over the course of 5 years, and then it goes back into that 1% growth for a period of 25 years, which I think is quite conservative given that Click's been around since 1951. The other possibility is that you just say we take this year's earnings and we assume no growth, apply a 12% discount rate. Upside DCF gets to about $1.2 billion. That equates to about $16 a share. I always like to do an assessment to determine whether $16 a share is a reasonable number. At $16 it would be on a PE of about 8, and the enterprise multiple, which is EBITDA and enterprise value, of about 4.2, which is still quite cheap. It has historically traded at premiums to both of those two numbers, and that discounted cash flow assessment excludes the $500 million in cash that Click has on its balance sheet, which equates to about another $6.50 per share. So one other way that we could conduct this analysis, and I prefer a reverse DCF for this reason. We can see what the implications of that market capitalization are. Here, I think the market is looking at the next 5 years and saying there's going to be no growth, or there's going to be negative growth in the order of 8%, which leaves you with earnings at the end of that of about 65% of where we are now, and then no growth thereafter, which I think is probably an unreasonable assessment because it has grown and it has generated income and earnings over that period of time. Another way of looking at that is it's negative 4% in perpetuity, which is not likely either. Or we can take the 5-year average of earnings, $80 million, and assume a 1% growth in perpetuity. But that gets us to the market capitalization, and that gives us no value for the $500 million in cash. So the risks to Click are genuine. It's a cyclical business, and we are in a global slowdown, and that is reflected in Click's business already. It peaked at $830 million in revs in 2011. Now TTM's more like $745 million. I don't think that the risk is so much to the business, but to the assessment of the business, that it's entirely possible that it turns into a loss maker over the next few years, and the market being what it is, that it'll trade down on that basis. I still think the valuation on a conservative basis is higher, but I don't know where it's going to trade over the next period of time. What I see as an advantage, a debt-free, cash-rich balance sheet. The obvious possibility is that it leads to a silly acquisition. They are considering an acquisition. I'd much rather they bought back shares, but that's a genuine risk too. There's also the ever-present in any technology business. The risk is that there's some technological change. Click spends a lot of money on R&D compared to its competitors, and so I think that that's a lower risk. And in a broader sense, the reason that I include technology businesses in my screen is that I've tested both ways, and excluding technology businesses or including them, and I get better performance including these technological businesses. To summarize, the downside for Click, I think, is its net current asset value, which is only about 35% below the current market capitalization. If we look at it on a DCF, we get to about $1.2 billion, which gives you no value for the cash. It does have a debt-free, cash-rich balance sheet, so it will be able to survive any slowdown, but that does create the risk of some silly acquisition. And the genuine risk is that it's a cyclical tech business in a global slowdown. But I think that that's more a problem of perception rather than a problem for Click's evaluation. Now I'm just going to shamelessly plug the book. It's called Quantitative Value. It's available from Wiley Finance or through Amazon. You can see a shorter version of the ideas in the book in a white paper that I have on Equum's website called Simple But Not Easy, The Case for Quantitative Value. And I'd like to open it up now to questions. If you'd like to get in contact with me, those are all of the ways that you can reach me. That @Greenback is my Twitter handle, and I'm a huge fan of Twitter, so I'm on it all the time, so feel free to contact me through that.
Great. Well, thank you so much for your remarks. Very interesting, and also thank you for taking the time to really illuminate the quantitative approach to value. I think this really whet all of our appetite for your book as well, which we highly recommend. and it has a lot more great data and studies referenced in the book. If you would like to ask a question, you can still type it into the online interface. We do have a few questions already. One relates to the use of these pre-interest, pre-tax, sometimes DNA metrics. Have you seen what the performance would be like by using some of those truly bottom line measures like net income or free cash flow?
I can show you on the chart. If we're looking at, is that chart large enough to be seen, or should I go back into the presentation? What's that?
That's fine, actually.
If we use we've backtested these metrics over an approximately 50-year period, and we've looked at them on the basis of the raw performance over the entire period, and we've looked at them on the basis of rolling 5-year and rolling 10-year performance. We've also looked at them on volatility basis. There's no question that the best performance comes from the raw measures that look at EBITDA and enterprise value, or EBIT and enterprise value. I think you can see I've only put EBITDA on this chart. EBIT actually gives slightly better performance again, but they're approximately equivalent. It makes almost no difference. And I think that the reason for that is that there's a lot more information in those metrics than there is in these other metrics. Enterprise value is the closest that a value investor might come to, and there are different definitions of enterprise value, but the one that we're using here is market capitalization minus cash plus debt minus prefs, and that provides better performance than any other metric, and that's quite wide outperformance. You can see that it's almost 1.5% over a 50-year period. That's substantial outperformance. PE is still a very good metric, but it just doesn't deliver performance that's as good. And I think that's because the E metric is much more subject to manipulation, and the P doesn't tell you enough about the balance sheet. So I hope that answers the question.
Yeah, absolutely. I should just mention that we actually profiled Click in the latest issue of the Manual of Ideas, which was the deep value issue, and it's available in the conference area for all of you that want to take a look. And we did talk about the capital allocation as one of the major risks, given that you have such a huge cash balance. And I'm just wondering whether you've tested share repurchases as part of your model, and whether that helps the model outperform or not.
We've looked at buybacks, and we've looked at total shareholder yield, which includes dividends. So I think that's a superior metric to just looking at the dividend yield. And the reason for that is that there are plenty of companies out there that pay dividends but issue more shares than the dividends that they're paying out, and they're penalized for the share issues in that metric. Whether you use buyback yield or total shareholder yield in being dividends and buybacks, both of those lead to better performance. The reverse is not necessarily true. A company that's issuing shares doesn't necessarily lead to lower performance, even though that as a value investor that's not something that you want to see. When I test it quantitatively, I think that often that risk is built into the valuation. You're already getting these things at such a cheap price that even if they do issue a lot of shares, which sometimes they do, you're not penalized. That's my narrative fallacy for the data.
Great. Our next question from Dave Sather, thought leading investor down in Texas. He writes in, You referenced purchasing a basket. How large or small of a basket do you recommend when you ran your study on value versus glamour from 1963 to 2011? How large was the study? Do you find additional benefit associated with portfolios of 30, 40, 50 names or some other level?
That's an excellent question. And I've done a huge amount of research into the optimum portfolio size. So these are some general principles. I think that it depends a little bit on your own risk preferences and your own and the amount of money that you're investing. But these are some general principles that I can tell you. If you have a strategy that is predictive, as you move from a larger basket to a smaller basket, you'll get increasingly better returns. So this study uses this study used a quintile, which was about 400 stocks, and in a large cap universe, reasonably large cap universe, and it got returns of 4.5% in excess of the market on average over the entire period. It doesn't always beat the market, of course. There's periods of time where it underperforms, periods of time where where the value premium turns inside out, where glamour outperforms the value, and periods of time where value just underperforms the market. But on average and on balance, it does generate good performance. And so as you reduce the number of stocks and you get closer and closer to the best quality and the lowest price, you get increasingly good performance. And you're even protected in downturns more often because they don't tend to fall as far. The corollary to that, the tension to that decision that you have to make is it's a 1977 research on optimal diversification, and they find that somewhere between, to put numbers on it, somewhere between 20 and 30 stocks, there's no additional benefit from diversification. So the reasons why somebody might run a bigger portfolio than that are that they have more money to invest. And if you're running an equal weight portfolio, you're always going to be limited by the smaller stock. The most illiquid, smaller stock in your portfolio is the one that you have to be able to get whatever your portfolio allocation into that stock is. So you can look at these a variety of ways. You can examine it. Equal weight gives very good performance, or you can attempt some sort of Kelly type application of take the 5 best positions and make them bigger positions, take the next 10 and make them slightly smaller, take the next 10 after that and make them smaller again, and that gives you some of the benefits of the concentration and some of the benefits of the diversification. It's really up to each individual investor, but equal weighting a portfolio of 20 of these stocks will give you very good performance.
A follow-up question on EBIT to EV as a key sort of indicator. When you find companies with similar EBIT to EV numbers, let's say Microsoft and Walmart right now, what would be the next best metric to use if you had to choose between one of the two?
Obviously, a Walmart might have some. It has some things that aren't captured in that sort of assessment because it has stores. I'm not sure whether it owns all its stores. I just haven't ever had a look at Walmart or whether it leases some of those stores, and so that wouldn't be caught in the enterprise value. But that's why. So if you're in a deep value world like I am, and that sort of metric favors companies that have a huge amount of cash on their balance sheet relative to their market capitalization and only very low, so they can have just a stub business, just a business that's in total decline, but because they have so much cash, the enterprise value is so small that even that very small business, the EBIT to enterprise value looks very healthy, even though you're really just buying a cash box with a declining business. The way that I get around that is that that quality metric that I use, gross profits on total assets, does the opposite thing. It penalizes you for carrying a lot of cash. So if you're a billion-dollar company and you have $950 million in cash, and your enterprise, your EBIT is in the order of $25 million, then that's a tiny little business given how large the market capitalization is, but it's quite a big business given how small your enterprise value would be. But then that business would be, on the gross profits to total assets measure, would be penalized for holding that cash. So that would be $25 million on total assets, or if we assume it's got no other assets, on $950 million, which would be a very small return. You can see Click generates 46% on, even including that chunk of cash there. If it was to pay out that cash, its return, it would be close to 100%.
There's a question.
So gross profits to total assets is the measure.
Okay. A question on strong balance sheets, and value investors will often say they look for companies with a strong balance sheet. However, that's an ambiguous and subjective judgment. Is there something specifically that you would use or require in order to categorize a company as having a strong balance sheet?
There's several steps that we go through. I don't necessarily need a strong balance sheet in isolation. I'm looking for financial strength. And financial strength is really a two-step process that does involve an assessment of the balance sheet, but it's also an assessment of the operating business. So EV/EBITDA does achieve some of that, does achieve a lot of that. It's already looking at something that it rewards cash on the balance sheet, and it rewards money or accounting money coming in relative to the remaining value that you have to pay there. But I also use those financial distress risk measures, which I can just pull up very quickly. This was just a very brief overview of these metrics. We use others. They're discussed in some detail in the book. They're just statistical measures that look at operating issues and balance sheet issues. But in relation to the balance sheet, it's more cash and less debt to make it as simple as possible. And I think that Graham would have said the same thing, which is why when he simplified it, he said debt to equity below 50%. So I think that's a pretty good metric.
I'd like to go to Oliver for a question, and then we'll come back to the queue. Oliver, go ahead.
Thanks, John. Toby, I'm curious about the any adjustments you make. For example, with Click, it seems that the cash balance could vary quite a bit. And how do you perhaps adjust for the working capital there? And if you could make a larger point, perhaps tying that into your methodology when it comes to making any such adjustments, and then how that affects the attractiveness of the individual companies that you're looking at.
It's not an assessment that I would do typically. The reasons why we've looked at this on the basis of trying to find some big muscle movements that are predictive of returns in the future. And we've tested a lot of these, and by big muscle movements I mean EV/EBITDA, gross profits on total assets, and then eliminating the riskier stocks. So that's not a process that I would go through typically, and it's not something that I've tested. It may improve the returns. The risk that you have if you're running a quantitative approach like this is that you are going to pick up some stocks that a more careful assessment by a value investor wouldn't necessarily buy. And the trade-off, there are several trade-offs that you have to make. One of the trade-offs is that you're not going to know the stock as well as somebody else, but there are good behavioral reasons why applying this model over, I mean, for me personally, it's a better process. It makes me a better value investor than doing the qualitative assessments. It's going to be a subjective question for each person, how you get the best performance out of your portfolio. And mine has always been the closer I hew to models that work, the better my performance. So I've sort of not really answered the question, Oliver.
Yeah, it's an interesting one, isn't it? I guess what I'm trying to get at, even simple things like an enterprise value, it really depends how much cash you subtract. So it seems that you need to make some subjective assessments, you like it or not. So I was just curious how far along that slippery slope you're...
Sorry, we do that. It's a net cash. It is a net cash assessment. It does back out working capital for that reason.
Right, but it takes the latest financial statement as is without making any further adjustments.
That's correct.
Okay. Well, thank you very much. I'll send it back to John for any further questions.
Thanks, Oliver.
John?
Yeah, thank you. Greenblatt recommended an annual assessment with minor variation depending upon desired tax consequences. How often do you turn over your portfolio?
In backtest, in the same way that concentration leads to better returns, the more often you rebalance, the better your returns are going to be. But that assumes back-tested models don't have to pay tax. And when you do have to pay tax, there's an enormous drag from the tax. So most of my investors are high net worth individuals, and for them that's not a theoretical thing, it's a genuine tax that they have to pay. So I run my model in such a way that if the winners are held until they can achieve long-term capital gains, and losers that fall out of the model are sold. So it can be that one quarter this might pick up a stock, and that the fundamentals deteriorate so much over the course of a quarter that the stock is down and it falls out of the model, and it's sold for a loss, and that can happen over the course of a quarter, and that has happened. So winners are held for long-term capital gains, but they can be held in any given year. The turnover in my portfolio is about 25%, but winners are held for long-term capital gains and losers are sold for short-term capital losses.
A question on the gross profit to total assets metric that you mentioned with regard to quality.
Yes.
Any particular reason why you think that's doing better than, say, net income to tangible assets or anything? I mean, is it a matter of kind of data mining, or are there some real reasons why this should do better?
Nobel deals with it in his paper, and he says that gross profits is close to the top line, and so it's not really subject to manipulation. And it's a better metric than sales because the gross margin really distinguishes between different types of businesses. And total assets is again another metric that isn't really subject to manipulation, and that it's not penalized for. It's not affected by the way that the business is financed. It's only looking at the assets. To the extent that that's Novi Marx's narrative fallacy, I don't know. He's tested that, and we've tested it separately by itself, and we've tested it in a deep value context. And both ways that we've tested it we found that it outperforms, and that's even through our system where we penalise companies for having large market capitalizations, and we look in a large cap universe. It's still predictive in that universe. Is it data mining? It could very well be, but we've checked it a number of different ways, and there are some reasonably good arguments for why it should work. But you're absolutely right. There's no way of knowing absolutely.
And perhaps last question that we can still squeeze in, and this one is a bit more qualitative, so I don't know how it can fit into your quantitative model, but here it is. If you invest in turnarounds, what do you look for and how far along do you like to wait into a turnaround before you invest?
I would wait until it appeared in my model and then I would buy it, would be my answer. We apply the models very strictly. I think Medallion Fund Jim Simmons, he says something like, why have we been so successful? We look because we look at our models and we faithfully apply them. Do you like what the model says? Do you not like what the model says? It doesn't matter. You faithfully apply it. So I use that rule in my business. If it's in the model, we buy it. If it falls out, we sell it or we don't.
Great. Well, on that note, I'd like to thank all of you for attending this session, and a special thanks to you, Toby, for taking the time to so generously share your investment approach as well as the investment idea. We appreciate it very much.
My pleasure. Thank you very much, John. Thank you very much, Oliver, and thanks very much to everybody else. If you're ever in Santa Monica, I'm always available to meet or chat.